We are on homework 11, page 5. All right, this looks just like 3 and 4 with just some different numbers. This time we have a note issued on July 15th, principal of $10,000, term of 180 days, interest rate of 12%. Now you're probably wondering, why are we doing the same thing over and over again? This is a concept that I really want you to know and one that requires a lot of practice. So I've given you a lot of practice here in your homework, so that by the time we get to the quiz and the exam, you're going to be like, I totally know how to do that. All right, so on what date must the note be repaid? All right, so in July, the note is going to be outstanding for 31 days in July, minus it was issued on the 15th. We don't count the date of issuance. So 16 days in July, it will be outstanding. In August, it's going to be outstanding for 31 days. So plus 16 plus 31. So as of the end of August, the note will have been outstanding for a total of 47 days. In September, the note will be outstanding for 30 days. So 47 plus 30. So as of the end of September, the note will have been outstanding for 77 days. October has 31 days, and as of the end of October, the note will have been outstanding for, I don't know why it's doing those percentages. 108 days. November has 30 days. And as of the end of November, the note will be outstanding for 138 days. December has 31 days. As of the end of December, our note will have been outstanding for 169 days. In January, we don't need all 31 days of January. We only need an additional 11 days. And so as of January 11th, 2021, our note will have been outstanding for a total of 180 days. So on what date must it be repaid? January 11th, 2021. What is the total amount of interest to be repaid at maturity? That's going to be our principal times our interest times 180 divided by 360. $600. What's the total amount of interest incurred as of 12/31? Well, we said at December 31st, this note would have been outstanding 169 days. So it's going to be our principal times our interest rate times 169 divided by 360. Or 563.3333. And we're going to round to the nearest dollar, which is 563. All right, so at issuance, we're going to debit cash because we're going to get cash. The point of the notes payable, so we can get some cash. We're borrowing money for $10,000, and we are going to credit notes payable for that same $10,000. All right. As of 12/31, we have to record our interest expense, our 2020 interest. So we're going to debit interest expense for the amount of interest we owe for 2020, which is 563. We're going to credit interest payable because we're not actually going to pay the cash until the note matures. We'll just accrue it, debit an income statement account, interest expense, credit a balance sheet account, interest payable, which is the liability. All right, now it's January 11th. We got to pay off this note. So we're going to debit notes payable for the principal. We are going to debit interest payable for the 2020 interest. We're going to debit interest expense for the 2021 interest, which will be 600 minus 563. The total amount of interest we're going to owe minus the 2020 interest, which was 563. So we're going to, we've incurred $37 worth of interest expense in 2021. And we're going to credit cash for the principal That's the interest. Next, $10,600. So that's $10,000 principal plus the $600 interest. All right, that wraps up page 5.